Welcome to the debate. We are diving today into the prediction market sphere, which has recently seen just this explosive growth, really spearheaded by platforms like Polymarket. This is no longer some niche curiosity.
Not at all. It's mainstream now.
Exactly. I mean, we're seeing reports placing its valuation near $1 billion, and it's securing massive institutional validation. For example, that key partnership with Elon Musk's XAI. So the central question that comes out of all of this is, well, it's critical. Does Polymarket genuinely represent an efficient, reliable, and functioning market, or is its reputation fundamentally overrated and its structure flawed? I'm going to argue that it is a highly effective, legitimate, and profitable venue for aggregating information.
And I come at it from a different angle. While the financial metrics and those high-profile partnerships are certainly impressive, I'm going to argue that the platform's actual efficiency is, well, it's grossly overstated. I think we're looking at a system riddled with acute liquidity risks, chronic behavioral biases, and structural flaws that make it unreliable and, frankly, extremely high risk for most people.
Well, let's look at the evidence that this is a mature, efficient market. The institutional confidence, evidenced by that near billion-dollar valuation, it speaks volumes about its utility. And crucially, the platform demonstrates impressive predictive accuracy. Data shows that just 4 hours before resolution, the leading option wins a remarkable 94% of the time. I mean, that is an aggregation of real-world knowledge that very few conventional polling mechanisms can rival. And what's more, its P2P structure is just inherently fairer than trading against massive institutional giants. We now have this entire sophisticated ecosystem of analytical tools, platforms for tracking smart money, trading bots, all of which proves that a repeatable, actionable edge, or alpha, exists.
That's an interesting point, though I would frame that P2P structure very differently. While it sounds decentralized and fair, it fundamentally means Polymarket is a zero-sum game. For every single dollar won by that 94% accurate bet, a dollar has to be lost by another trader. And that kind of environment is highly susceptible to fundamental human behavioral flaws, which really undermine efficiency. We see these rampant positive feedback loops. It's like chasing a stock just because the price is going up, not because of new information. Traders buy yes because they see the probability rising, and that just creates an inflated bubble. This leads to predictable mispricing. And to illustrate this inefficiency, empirical data shows that markets priced at a 62% expected probability of resolving to yes, they only actually resolve to yes 53% of the time. That gap demonstrates that the market is chronically overpriced because of this collective unfounded optimism. It is structurally inefficient.
I see why you think that, focusing on the average user's failure. But let's address these behavioral biases directly. You are absolutely right that groupthink and the failure of traders to, set their own price exist, especially in hard-to-price events like political speeches or some niche outcomes. But the existence of that very bias is the edge. If the average trader is predictably making a mistake, always overpricing the yes side, that behavior is information. Sophisticated traders are not swayed by the current market odds. They use these tools precisely to identify where retail money is overconcentrated. They look at ownership distribution. Are the bets in a few whale wallets or spread across thousands of small, potentially unsophisticated ones? They align with the stronger traders. If 88% of users are losing money, as research shows, that just means there's a vast, predictable pool of behavior waiting to be exploited by the 12% who have mastered the game.
I'm not really convinced by that line of reasoning because you are defining efficiency only from the perspective of the expert exploiter. If the market is only efficient for that 12% who are essentially just extracting value from the other 88%, then how can we possibly call the market a reliable source of public truth? It's not. It's fundamentally a wealth transfer mechanism. The reason experts tell traders to assign their own probability before looking at the market odds is exactly because of this. If you get swayed by high market odds, you just become part of the bubble.
That is true. But those tools are what differentiate a mature trading environment from a simple betting pool. The complexity goes far beyond just reading a chart. The P2P nature allows for complex, low-risk strategies like arbitrage sniping mispriced contracts between Polymarket and other exchanges, locking in risk-free profit. You can actively countertrade consistently poor performers you identify through analytics. And for traders with lower capital, you can parlay correlated bets, multiplying a small edge across related events to achieve significant payouts, sometimes 32x odds. That level of strategic complexity indicates a profitable and adaptable trading environment.
That's a compelling argument, sure, regarding the specialized strategies, but all that sophistication is useless if you can't get a reliable price fill. And that brings us right to the issue of liquidity. These are decentralized markets, not centralized exchanges, and that creates massive friction. If a trader tries to place a large order, say $10,000, they often suffer from massive slippage.
Right.
And for our listeners who might not be familiar, slippage just means that when you place a large trade, the order book doesn't have enough shares at your price. So you end up buying shares at increasingly worse prices, which shaves off your expected profit. The source material highlights these painful examples where a large bet only yielded an $11,000 return when a 2x return was expected, purely because the order book couldn't support the fill price. The liquidity just vanishes in those niche markets.
I will absolutely concede that execution risk due to illiquidity is a challenge, particularly in low-volume markets. It's a friction in a decentralized system. However, the market is adapting, and it's adapting rapidly. The advancement of automated platforms, things like Fraction AI, which let users set up trading bots with stop losses, it helps manage this risk algorithmically. You're not fighting the order book manually anymore. More fundamentally, the existence of funds and staking services that aggregate capital and handle the execution for you, they essentially democratize access. This ecosystem wouldn't be growing if the liquidity problem were crippling the ability to move capital.
But the solutions are only managing the symptoms, not the structural disease. Let's pivot to what I view as the single greatest flaw here, which is information asymmetry and insider risk. Because Polymarket deals with real-world events, CEO earnings calls, political shifts, the potential for true insider trading fundamentally breaks any claim of fairness for the average trader. The easiest markets to rig and the most dangerous for retail are those obscure mention markets. An insider, knowing a CEO will or will not say a specific phrase, can place a massive, guaranteed bet. And retail traders get killed when they see a huge, sudden market shift based on information they couldn't possibly have.
Well, the risk of insider trading is real and severe. The transparency of the public blockchain is actually Polymarket's ultimate defense. It's something traditional exchanges can only dream of. The decentralized structure means that tools now exist, like the Hashdive Insider Trading tool, that allow traders to actively track suspicious activity in real time.
But you need a tool just to watch out for it?
Of course. Users can screen for new wallets with no trading history that are suddenly placing huge bets. They can analyze the wallet creation time versus the transaction delta, that is, the time between the wallet being created and the huge bet being placed. This transparency turns potential insider risk into actionable intelligence, allowing savvy traders to protect themselves or even counter-trade the detected behavior. The information is out there. That makes the market ultimately more robust against corruption than legacy systems.
But the fact that we need specialized analytical software just to defend against insider exploitation reinforces my original point. This is not an efficient market for public discovery. It is a high-stakes, highly complex game only truly accessible to those with the deepest analytical capabilities. You need a full surveillance system just to avoid being exploited by someone who knows the outcome ahead of time.
Indeed, Polymarket, through its impressive valuation, key partnerships like XAI, and its demonstrable ability to aggregate information into a single probability, offers significant opportunities. For those willing to invest in the analytical tools and develop a repeatable edge, exploiting the predictable tendencies of less sophisticated participants remains highly profitable. The alpha is real, and the market is responding.
My final summary remains one of caution. While yes, undeniable alpha exists, the market demands exceptional sophistication, careful attention to liquidity issues, and constant vigilance against structural risks like insider trading and behavioral bubbles. As Maxim Anisimov outlined in his comprehensive analysis on Bytework.com, understanding these limitations is key to survival. The environment is less a level playing field and more a high-risk, zero-sum battleground.
Ultimately, what we've seen is that the debate over Polymarket's efficiency is less about the platform itself and more about the tools and the discipline brought by the individual trader. The core question remains, is Polymarket working or is it fundamentally overrated? The complexity of predicting the future really demands rigorous analysis before you commit capital.
And that is the true takeaway. Whether you see Polymarket as an engine of decentralized efficiency or as an overrated gamble depends entirely on your preparation and your willingness to play a defensive technical game.
We want to hear what our listeners think. Be sure to subscribe to the debate, hit the like button if you enjoyed this discussion, and let us know in the comments. Do you believe this prediction market model is sustainable and reliable, or is it fundamentally flawed? Thank you for listening.